One thing I never really do on my channel is I never go to the same area or neighborhood 2 weeks in a row because I like to change up the content, change the scenery and stuff like that for you guys and for myself to just keep it fresh. But this week we're doing something a little different, and I am going to retrace my steps from last week, and we're going to revisit a listing that is for sale that I'm about to show you guys because I covered this listing in a video I did last week. But right now, I'm going to show you just how bad this whole insurance and property tax situation is here in Florida, because it is so much worse than you think. So the house we're talking about is this one right here. Now, there's nothing in particularly wrong with this house. This house is just a house that caught my eye because it was for sale, and we put it in the video from last week. However, one thing I'll bet you didn't know about this house is it would cost you about $20,000 to $25,000 per year to put homeowners insurance on this house. And yeah, if you need to rewind that and hear me say that again, that is the correct number, guys. $20,000 to $25,000 per year. How do I know this? Well, one of my insurance insiders reached out to me because a couple of weeks ago I asked somebody who writes insurance to reach out so he can give me some quotes on some properties I come by, and it was absolutely shocking, guys. So I'm going to go over this with you in detail on how we arrived at this number and why it costs so much money to insure this house. But guess what? It's not just this house, it's this entire neighborhood. All these houses around me that you guys are going to see would be paying a similar amount in property insurance each year. So first of all, $20,000 to $25,000 a year, that's an extra $1,650 to $1,700 per month just for homeowners insurance, okay? And then if you throw in the property taxes on that house back there, the current tax bill is $48,000 per year, guys. That equals an extra $5,700 to $6,000 per month just for property taxes and insurance on that house. So say if somebody was to buy that house with no mortgage, they're asking $3 million. They pay $3 million cash for this house. They're still going to be paying $6,000 a month just in property taxes and insurance. But if you think that's bad, it gets much worse than that. Because if you actually do need a mortgage on the house, well, then your numbers change substantially. Because even if you put 20% down to buy this house, that's still a $600,000 down payment. And at today's 7.6% interest rate, now you're paying $23,000 a month, okay? So literally the property taxes and insurance alone for the carrying costs of this property is 26% of your monthly expense, okay, when you have a mortgage. So as somebody, like, say if you wanted to move to a neighborhood like this, tell me how you would justify spending $23,000 per month on that house payment with all the property taxes and insurance versus if you wanted to rent something. Because if you look at some nice houses around here for rent, the average going rate's anywhere between $12,000 to $14,000. Some of them are even under $10,000 a month. You could even rent this house here for $14,000 a month. Beautiful waterfront home. Could even have a boat parked behind your house for $10,000 a month less than it would cost to own that house. So why would anybody buy that house? That's beyond me. I have no idea, guys. But what I want to look at today in this video is why is this insurance so absurdly expensive? Now, according to my insurance insider, unfortunately, I cannot reveal who they are because I don't want to get them in trouble. But I was able to get several real-life insurance quotes on this property with some in-depth explanation of why it would be so expensive to insure this house. And really this entire neighborhood. It's not just that house. So number one thing is the flood zone, okay? This region that I'm walking through right now is a FEMA flood zone region AE, okay? So if this house is financed, if somebody buys this house with a mortgage, the lender is going to require flood insurance. That's not going to be an optional thing. You're going to have to get that. And even if your lender didn't require flood insurance, if you have citizens insurance, which most likely the person who buys this house will have citizens, which we'll get to, citizens requires you to have flood insurance no matter what now. So even if this wasn't an AE flood zone, you would still need to have flood insurance if you had a citizens insurance policy. Now the other thing is, because you need to have flood insurance, it's a requirement. The National Flood Insurance Program only covers you up to $250K, and property value. So you have to go beyond that and get a second flood insurance policy, which would cost you about $5,470 a year on this house. And there's a couple other things working against this property, mainly the age, because this house was built in 1948 and it was renovated in 1992 and the roof was replaced in 2005. So even if they updated all of the plumbing and the wiring in the early 90s when they did their renovation, the home would still barely qualify for most insurance carriers. So when you're looking at properties, especially here in Florida, what you want to see when you're looking at flood zones is you want to see flood zone X, because that's going to be the most favorable for you as the home buyer. And also the age of this house really hurts it because of the fact that it's so old. Whenever you go to insure an older house, the reason that older homes are more expensive to insure isn't necessarily what everybody thinks. Some of it is building codes, yes, but insurance companies charge a lot more to insure old houses because the likelihood of you making a claim or something happening to that house is higher than with a brand new house, at least according to insurance companies' data. And the other big problem with all homes that need to be insured, especially here in Florida, is how old is the roof? Well, if you heard what I said a minute ago, the roof on this house was last replaced in 2005. That was 19 years ago, guys. So you could say that the roof of this house is probably getting close to the end of its life. And in order to get insurance on a house that has 20-year-old roof, there's a high probability you're going to have to replace that roof. So now you're looking at probably at least another 30 grand invested into the house before you can even get insurance on it. Here's the thing, my insurance insider gave me several different quotes from different insurance companies, and most of the insurance companies just rejected the property flat out because of, number one, the flood zone that it's in, and number two, the age of the property. Just based on those two things alone, almost no carriers would touch it. But if you take that same house and say if it was built in 1992 or later, then you would probably have more options. So that's the other thing. If you're looking to buy a house, especially no matter where it is across the country, guys, buying a newer house is going to increase your insurance options, just so you know. And a lot of people don't like newer houses. People say, oh, it's not built great, the quality's not there. Well, according to the insurance companies, you're more or less likely to have a claim on one of those properties, so they're more willing to insure you. So something to think about. But like I said earlier, guys, this is not a problem of just this house. Every single house you see that we're walking past is going to have this same issue. Because one thing I keep bringing up on my channel that I want everybody out there to understand, whether you're a current homeowner or you're looking at buying a house in the future, is property taxes and insurance are enemy number one right now when it comes to homeowners' expenses. If anything else could bankrupt you, this is it right now. What I'm showing you in this video is just one small example of this. Because say somebody in this neighborhood, say this person behind me in this house, say they bought this house 30 years ago. They have very low property taxes, but that doesn't shield them against having a higher insurance rate to match the rates of today. Like the rate that we saw on this house in the beginning, that person's still paying the same rate as this house down the street. Because it's in the same neighborhood, it carries all the same risks. They're both old houses and both in the same flood zone. Even if you try to do everything right in life, you pay off your mortgage, try to make yourself get to retirement, you have a low property tax bill and all of that, sometimes it's still not enough because of the insurance bill. My insurance guy said that, listen, if that house was built later on, like say after 2007, when building codes were improved and had full hurricane protection like impact glass, shutters, the whole 9 yards, they would still be paying at least $12,000 per year in homeowners insurance and $3,000 per year in flood insurance. So still a $15K per year insurance bill in best case scenario. So you could take one of these brand new built homes around here, because sometimes we'll see one where they're building a brand new house. They're still gonna be paying at least $15K a year. And I know a lot of this might be shocking to you guys. It was shocking to me as well. but it's something I want to bring up more and more here on the channel because a lot of people just don't realize it. Like, you think the prices of these houses are crazy, but it's even more crazy what you pay in property taxes and insurance, which is something that you can never escape. Of course, if you pay the house off, you don't have to have insurance anymore, but you're taking a massive risk, first of all, by not having it, because if something does happen, you're going to be completely responsible for paying for any of the damages. But another reason that people need to understand that this whole neighborhood is in trouble with insurance is because when you're paying for insurance, you're not actually paying for the price of the house. Like, technically, okay, you know, insurance might be more expensive a lot of times on a house that costs more, but that's only because the replacement cost might be higher. Not in all cases. In some regular houses like this, replacement costs might not actually be higher. So you're paying for what it would cost to potentially rebuild your house in the case of a catastrophe. And here's some examples of these quotes, guys. I'm gonna put them up on the screen so you can see. This is an insurance quote for this house for $24,200 a year, and that does not include flood insurance. So that's an extra $5,000 a year. So now you're looking at $29K a year to insure this house. Oh, and by the way, these numbers had to be fudged. In order to even get these quotes, they had to put in there that the house was built in 1992 or later, or these companies would reject the house altogether, just so you know. So these quotes, even if they would insure the house, is how much it would cost, but they won't insure it. Here's another one, and take a look at this payment plan for this second policy, guys. Like, literally, your first payment would be $95.73, second payment would be $14,600, third payment would be $4,786, fourth payment would be $9,840, totaling you another $24,000 to pay for this house. Here we have a listing for sale that's currently under contract. They were asking $2.15 million, and it's another old house built in 1956, so you can guarantee they're going to have a high insurance bill here as well. But just back in 2020, this house sold for only $675,000. Somebody flipped it a year later in 2021 for $1.3 million, and now they're flipping it again for around $2 million. Total insanity here, and somebody's going to end up paying another $25,000 a year homeowners insurance bill. I wonder if the new owner knows that. On top of that, the current property tax bill is already $26,000 a year, and it's going to shoot up to probably $40,000 or $50,000 a year when the new owner takes possession of this house. Have fun with that. Here's another quote where the total policy would be almost $32,000 a year, guys, before flood insurance. I mean, who is signing up to pay for this? Like, these houses around here eventually do sell, and the only way to get around not paying this is to pay cash for the property. So who is signing up for this? That's what I would love to know. Who is paying this? And once again, not really by a huge surprise, the best deal to insure this house was from Citizens Insurance. Citizens quoted only $14,000 a year, so still super expensive, but way less than these other companies. So it's basically a guarantee that whoever buys this house is going to insure it with Citizens, because it is by far the best deal. But even with Citizens plus flood, they're still looking at $19,000 to $20,000 per year, bare minimum, to insure this house. This one property, guys, just shows you the magnitude of this problem right now. And this is just one house. Imagine all these houses selling all over the place and how much it costs to insure them. Now, I will say that if you buy a more average house, it's not going to cost you as much, okay? If you buy like a normal house in Florida, probably a median price home, $400K, somewhere inland that's not in a flood zone, your homeowner's insurance is still going to be, you know, about $3,500 to $4,000 a year on average, okay? So way lower than what we're looking at here, but it's still a lot. So a lot of people might be asking themselves by now, like, well, even if you're not paying 20 grand a year in homeowners insurance, what can you do if you get a big spike in your insurance rate? Guys, this is happening to people all over the country. So many of you have written me from all over the place talking about your homeowners insurance increases, you know, all up and down the East Coast and the Carolinas and New Jersey. People have written me from Missouri, from Texas, all over the place are getting hit with major increases in their insurance. So what can you do? Well, the first recommendation from my insurance insider is to ditch your HO3 policy and try to get a DP3 or even DP1 policy. And basically, the main differences between these policies is it doesn't cover as many things that can potentially happen to the house, but all of the major things are included on all these policies. So the most likely big disasters, like a fire, for example, that say your house burns down, is going to be covered by all of these policies. But the difference is the DP3 and DP1 policies are a lot cheaper than your typical HO3 policy. So if you're looking to lower your rate, check into getting a DP3 or DP1 policy. See, like this house right here, for example, they're building brand new. I remember when they tore down the old house here. Might actually have a similar, if not lower, homeowners insurance bill than that first house just because it's brand new. It's built up to the modern building codes. There's gonna be less of a chance of a claim, according to insurance companies. Now here's the other thing, guys. When it comes to insurance, the number one thing I hear people say all the time in the comments and people write to me is that, Michael, I've had insurance here on this house for 20 or 30 years or something. I've never made a claim and they're boosting my rate tremendously, or they're dropping me. This isn't fair. And I completely agree, guys. It is not fair. It is criminal when they do that. Unfortunately, this happens to people all over the place with no warning. And the thing you have to understand that was explained to me is if this happens to you, it's not you, guys. It's not you as the customer that they're doing this. If they drop you, it's probably because the claims in your area are getting too expensive, or the insurance company is just full. They don't have any more room to write policies, or they determine that the risk in your area has just gotten too great and they're not gonna write there anymore. It's that simple. Here's the craziest thing, which I kind of already knew, but it's interesting to bring up here. And a big tip for anybody who wants to keep their insurance low: never make a claim. Ever, 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 guys. The moment you make a claim, you are now flagged as a higher risk moving forward in perpetuity, even if you change insurance companies, because all these insurance companies talk to each other. They're all in cahoots. And if you so much as call the insurance company and ask them a question like, hey, if somebody throws a baseball through my window, is that going to be covered? Well, you know what the insurance company is going to do? They're going to look at that question as now an unpaid claim on your property. Okay, they're assuming that it maybe already happened or that it will happen, and now automatically that makes you a higher risk. So you can't even talk to these people. You cannot ask them questions about anything. You should just pay your bill and shut up, or don't have it. Literally, that's how insane this whole thing is. Now, companies, when you go to sign up for insurance, are going to push you towards getting that HO3 policy because it does cover more stuff. However, after watching this video, or if you need to share this with somebody, share this video and let people know that, hey, there are other options available. You can get a DP1 or DP3 policy for your house. It won't cover as many instances, but all the major stuff is covered. And if you're following the advice of this video, and you're never going to make a claim anyways, unless there's a major catastrophe, then you should be fine. Basically, the saying goes like this, guys: unless the damage is literally catastrophic, the house has burnt down, or the hurricane has taken it away, you probably shouldn't make a claim. And the rule of thumb that my insurance insider gave me is that unless your claim that you're going to make for the property is 5 times more expensive than your annual premium, don't make the claim. So in the case of this house that we looked at, say they're paying $20,000 a year, well, 20 times 5 is $100,000. So unless they have $100,000 in damage or more, it's not even worth making a claim. That's how absurd this is. But people have to have it if you have a mortgage. Another thing you can do to save money on insurance is if you have wind insurance, you can drop it, guys. That is not mandatory. That's something you're paying for in addition, but you don't have to have it. And another thing that you can do, which might seem kind of obvious, but if your rate has gone up substantially, say you're one of these people where your insurance doubles or triples from one renewal to the next, then there is a higher probability that you're going to be able to get a better deal by shopping around. If it goes up incrementally, not so much. But if you get that major hit, that big increase, by shopping around with different insurances, you're going to have a much higher probability of securing a better and lower rate. And one of the easiest ways to shop around that was advised is don't talk to, like, say, Allstate or State Farm directly, guys. Not that it matters here in Florida. You can't get insurance with any of those companies anyways. But as an example, don't just go to the big insurance company and ask them for insurance directly. Work with an insurance agent. You know, they can source insurance policies from all different companies and get you the best deal, much like a mortgage broker does. Even when I was working in real estate, the number one thing I would always try to have all my clients do is get pre-approved with a mortgage broker instead of their bank, because their bank is going to have a much higher chance of denying them and not actually writing the loan when push comes to shove. And with a mortgage broker, you're going to have a much higher probability of getting a better deal, a better loan for a lower interest rate. So even if you end up having to pay a fee to the mortgage broker, 9 times out of 10, it's worth it. So the same can be said here for using an insurance agent. Use an insurance agent. Don't go straight to the source of these insurance companies, because they will quote you higher and they will make you feel like they have the best policy available and there's no use in even shopping around at any other company, which is completely a lie. Other things that you can do: raise your deductibles on your insurance policies, because remember, at first it might sound risky and scary to do this, but if you heard what I said earlier in this video and follow this advice, your goal is to never make a claim on this insurance anyways. You basically have this coverage in case of worst case scenario, but plan on never using it. Is kind of how this is supposed to go if you want to keep your rates as low as possible. So under those circumstances, what's the big deal if your deductible is as high as possible? What's the big deal if you drop the wind coverage? You're not going to be using it anyways. And you know what, guys? All of this applies to auto insurance as well. Like, if you are seeing big increases in your auto insurance, it pays to get an insurance agent and shop it around and see if you can find a better deal. Also, the same rules apply when it comes to raising your deductible and, you know, lowering the amount of coverage that you have, except for one good piece of advice that was given to me is the liability side of things. You don't want to have your liability, especially property damage, too low, because think about how expensive cars are today. You know, the average brand new car is already hovering towards $50,000, right? So if you get in an accident and you damage a $50,000 car, there's a high probability that the damage to that car is going to be higher than $10,000. And if it is, and you only have the state minimum insurance coverage of $10,000 in property damage, well, the rest is going to come out of your pocket. They're going to sue you for the difference. So you want to make sure that you have substantial property damage coverage with your auto insurance. But not only is the price of insurance getting out of hand, guys, but the reality is people are just tired of being lied to about the reasons why insurance is going up. You know, there was a story I saw today talking about, insurance is going up across the board because of lawsuits. They're blaming lawsuits as the reason why. However, according to some recent research data, they have proven that there's actually no data that supports this as the reason why insurance has been climbing so much. In fact, take a look at this chart here from Bloomberg. It shows you the charts going all the way back to 2014, so over the past 10 years, all of the reasons why U.S. insurance companies claim that they're raising their rates, okay? Fraud is always a pretty consistent one here. Wildfires started peaking around 2018, 2019. Those are some really bad years for wildfires. And then you have distracted driving as one of them, which has been on the decline by quite a bit lately. And the number one reason as of late is social inflation. That thing has been spiking here through the roof. Also, they've been using hurricanes as an excuse to increase rates. So a lot of different excuses to increase rates here. And funny enough, litigation is not any of these, okay? Even though that's the number one thing that they come out and say in the media of why they're raising rates is because of litigation. But in their earnings calls for all these insurance companies, these charts tell a different story. They say that hedge funds are even financing people to sue insurance companies these days. They'll give you a loan basically to sue the insurance company, and it's called litigation finance. And these lawyers increasingly shooting for higher and higher big winnings. Like we're talking, you know, the amount of cases that are being won in court of $10 million and more is increasing because of the lawyers that are doing this, supposedly. But you know what, guys? In my mind, they can make up any reason or excuse why insurance is going up. It doesn't really matter because, number one, in many cases, you're required by law to have it, so you have to pay it regardless of what their excuse is. And number two, let's not forget that no matter what their excuse is, all these top CEOs at all these big insurance companies are making a lot of money. I've showed this before, but I will show it again. Take a look at this chart, guys. Top compensated CEO in 2022 is State Farm CEO at $24.4 million. Then Travelers at $20.8 million. Allstate, $18.9 million. Liberty Mutual, $15.4 million. Geico, $13.6 million. Progressive, $12.7 million. Farmers, $9.7 million. And this list goes on and on and on. These top CEOs literally make tens of millions of dollars a year, but you have to pay more. Just remember that. And none of this even includes middle management or upper level management that make, you know, hundreds of thousands of dollars a year as well. Big time salaries at these insurance companies, but they're taking losses, they're not making money, so they need to raise your rate. But nobody on their payroll gets to take a pay cut. So I feel like this is one of the most important insurance videos I've ever made. So first of all, if you know somebody that needs to hear this information, please share this video with them. But also, if you're somebody who needs insurance in Florida, shoot me an email, guys, and I can set you up with somebody right now, just in Florida, but maybe in the future, other states as well. And I can help you get set up with somebody reputable that can help you out with this. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.